The recent slide in U.S. equity futures, triggered by a sharp sell-off in semiconductor stocks, isn't just another market wobble. It signals a far more profound shift in market leadership, a reallocation of capital that sophisticated investors have been anticipating. The question isn't if the dominant tech narrative would eventually cool, but when the institutional pivot would truly begin. This isn't just about profit-taking in a few chip giants, it's a strategic reassessment of risk and opportunity across the entire market spectrum, revealing hidden vulnerabilities and emerging strengths. The semiconductor sector has been the engine of innovation and growth for years. Companies like NVIDIA, AMD, and Taiwan Semiconductor, TSM, have built deep moats through intellectual property, manufacturing complexity, and essential components for AI and data centers. Their value proposition is undeniable, fueling everything from cloud computing to advanced robotics. But this unparalleled growth has also led to historically extended valuations, making them particularly sensitive to shifts in the macro environment. For institutional portfolios, understanding capital allocation goes beyond just a company's balance sheet. It's about how systemic liquidity is being allocated across sectors. When the market sees a sudden, sharp repricing in a high beta segment like semiconductors, it's a direct signal that capital is seeking new homes. This isn't random, it reflects a deliberate strategy to de-risk portfolios and identify sectors offering better asset insulation or less demanding valuations. We're witnessing a reallocation, not just a reaction. While we don't have quarterly earnings for the entire market, this chip sell-off is a market-level quarterly result. It represents a collective repricing of future earnings potential. When stocks like NVIDIA or Broadcom, AVGO, see significant corrections, it's the market's way of saying, the premium for future growth has become too high, or the confidence in sustained, accelerating growth is waning. This shifts the focus from top-line expansion to the sustainability of underlying margins. Here's where the margin metrics become interesting for the broader market. A sell-off in a high-margin sector like semiconductors doesn't necessarily mean overall corporate margins are contracting. Instead, it suggests a shift in where those robust margins are perceived to be found next. This capital rotation forces a valuation reassessment. Investors move from sectors where future margin expansion is already priced in, to those where it might be underestimated or more resilient in a changing economic landscape. Now, look at how the broader institutional market is managing this situation. The swiftness of the equity futures slide indicates a proactive de-risking. It's not just retail speculation. Major funds are reducing exposure to areas with stretched valuations and reallocating towards sectors offering more predictable cash flows or defensive characteristics. This market commentary from institutional flows is a strong signal about their execution strategy for the coming months. The next signal comes from where this capital is being reallocated. When tech leadership falters, you often see a demand recovery in traditionally stable sectors. Think healthcare, LLY, J&J, consumer staples, PG, KO, or even certain industrial names like Caterpillar, CAT, that benefit from long-term infrastructure trends. This is strategic capital allocation in action, moving out of crowded, growth at any price trades into segments with clearer earnings visibility and lower volatility. This sector rotation isn't happening in a vacuum. The macro environment plays a huge role. Persistently higher interest rates, concerns about a potential economic slowdown, and geopolitical uncertainties are all contributing factors. These elements increase the discount rate applied to future earnings, making long-duration assets like high-growth tech stocks less attractive relative to more immediate cash flow generators. It's a fundamental repricing of risk. The competitive landscape now isn't just within the chip sector, it's between sectors. Which industries are demonstrating true relative strength? We're seeing greater demand for companies with strong balance sheets, consistent dividends, and businesses less sensitive to economic cycles. This includes segments like utilities, NEE, DUK, and established financial institutions like JPM. They're acting as asset insulators during this period of tech weakness. The biggest vulnerability for high-growth tech now is its sensitivity to the cost of capital. Higher interest rates make it more expensive to fund future growth, impacting valuations. Additionally, any slowdown in corporate spending on areas like cloud infrastructure could temper the demand outlook for chips. These are structural headwinds, not just transient market noise, creating a need for careful trim consideration in overextended positions. Beyond tech-specific issues, there are broader systemic headwinds. Persistent inflation could pressure margins across all sectors, while potential regulatory scrutiny on tech giants remains an overhang. These factors push investors towards businesses with strong pricing power and operational efficiencies. We're looking at where capital can find both growth and resilience in a more challenging macroeconomic environment. Looking ahead, forward earnings visibility is paramount. For the chip sector, the question is how quickly the AI narrative can re-accelerate and absorb current oversupply concerns. For the new leadership sectors, the outlook is clearer, often backed by stable demand and less cyclical revenue streams. Institutional investors are prioritizing companies with clear revenue pipelines and robust demand curves, even if their growth rates are slower. This period of sector rotation demands a comprehensive valuation reassessment. Are the previous growth premiums for tech still justified? Or are we seeing opportunities in overlooked value segments that now offer a more compelling risk-reward profile? This isn't about calling a market bottom, but rather identifying where capital can be strategically positioned for multi-year structural momentum as market leadership evolves. So, where does this leave us tactically? We are seeing a trim consideration signal for segments of the semiconductor sector that remain highly valued despite the recent slide, particularly those with less diversified revenue streams. Conversely, we are putting several quality names in defensive sectors on breakout watch, companies with stable cash flows and strong balance sheets that are now attracting significant institutional flows, signaling a potential shift in market favor. This is where smart money is finding asset insulation. This isn't merely a correction, it's a recalibration. The market is adjusting to new economic realities, and those who understand these structural shifts will be best positioned. At SR Money News, we continue to provide institutional-grade analysis to help you navigate these complex markets. Ensure you're subscribed and have notifications turned on, so you don't miss our deep dives into where the smart money is moving next. Your portfolio deserves this level of insight.